Hi, I'm James Surowiecki, the business columnist for The New Yorker, and we're here today to talk with Michael Mauboussin. Michael is the Chief Investment Strategist for Legg Mason, one of the biggest mutual fund companies in the world, and he's also an adjunct professor of finance at the Columbia Business School, and the author of a new book from the Harvard Business School Press called Think Twice. Just a really fascinating book about kind of decision-making problems and flaws and how we can think better. And Michael is, I think, one of the most interesting thinkers out there on business and finance today. So I thought we could begin by talking about what we've gone through over the last couple years. If you think about the stock market, which you work for Legg Mason, which is primarily an equity firm, the ride has just been absurd.
Exactly.
And for investors, I think, has been traumatic. So you can see now people are really hesitant to get back in.
Big time.
What lessons should investors take away from the past 2 years?
I think the psychological stuff's really interesting, and I'll mention one study which I think is a really cool one to get people to think about this. And this is a study of people with brain damage. Now, of course, this is very tragic, the brain damage, mostly stroke victims, but the key is the brain damage had nothing to do with their ability to do math, calculate, but rather their emotional seat, ability to feel fear and greed and anxiety. And here's how the game was set up. They gave everybody $20, so you were endowed, and you played 20 rounds of a game. And each round you could do one of two things. You could just keep your money and go on to the next round, or you could hand your dollar over to the researcher who would flip a coin, and you could pay $2.50 for the right answer, and you lose your dollar for the wrong answer, right? So you work out the math. It's $1.25 expected value versus $1 expected value, right? Now you're supposed to end up with the most money. So what do people? And they pitted these brain damaged people against normal people.
So rationally, you should take the bet.
Rationally, you should take the bet every single time. So what happens is the first 5 rounds of the game, everybody gets this, and they pretty much hand their money over to the researcher, right? But at the end of the day, the brain damaged people ended up with 13% more money. Right? In part because they played many, many more rounds than did the normal people, and in particular, twice as many rounds after having suffered a loss. Right? So you can see, you can imagine yourself playing this game, and you're saying, I get this, so you hand the dollar over, and then after a couple times you lose, and you go, you know what, that doesn't feel so good.
Especially if you lose a couple, 2 or 3 times in a row.
And you go, I'm just going to sit out a round or two, just chill out, right? And then I'll come back into it later on.
Even though it's completely random.
Even though it's completely random, and they know it's completely random, right? They know, they understand this. So the point here, I think the important point is, people will knowingly give up net present value positive investments if they've recently suffered losses. They will knowingly give up what is really good. So I could have come to you a year ago and said, the S&P 500 is 670. You know, the earnings power of the thing is $75 or $80. You wouldn't have to do any fancy math to know that actually looks really good.
Really good.
But your response was, hey, I've just lost a boatload.
Right.
I'd rather just keep my dollar in my pocket. Thank you very much.
Right.
And so this is like one of the big lessons is, and by the way, the inverse is true too. If you won a whole series, you know, you want to just keep going at it. So you could do an inverse. But I think that study is one of the most powerful one to demonstrate this basic idea that as humans, we have this loss aversion, and that kicks in high gear, and we get paralyzed or don't participate.
Right. Because the losses hurt you more than the gains.
Losses hurt you about 2 to 2.5 times more than the gains. So you and I might be looking at the same risky asset, and we could agree on all the, the cash flow streams and so forth.
Right.
But if I'm evaluating it really frequently and you're less frequently, you'll pay more for that risky asset because you'll be able to sidestep, in effect, that loss aversion.
Right. At the same time as we are social animals and we imitate, we're also optimistic and often overconfident, right?
Right.
Which seems to imply some kind of indifference to what other people think. So how do you make sense of those two things together? Our overconfidence and our kind of reliance on what everybody else is doing?
Well, yeah, I mean, I think a lot of that overconfidence and comes about our own futures, so ourselves in a large degree. And so, I mean, I think psychologists talk a lot about the 3 illusions. The first is the illusion of superiority, which if you ask people, are you better than the people around you, they will almost say, always, in private, they'll say yes, right? So are you better than the average driver or top half of 80% of people say yes. My favorite on this, by the way, is 86% of Harvard Business School graduates say they're better looking than their classmates. Right? So people just think of themselves as good. And the other is the illusion. Yeah, the illusion. Another one's about the future, which is if you say, how does my future look versus that of others? You also see your future is quite bright. So, for example, they'll go to college students and they'll say, all right, you're going to have relationships and you're going to have careers and life and death and all these things. You get that, and they all say yes. They'll say, now rate your prospects for good relationships and good careers and so forth and good health versus the bad. And they just deem their own prospects as much above average and bad things happening much lower than average. The third one is the illusion of control, which is when we perceive ourselves in control of a situation, we think our probabilities of success are much higher than they objectively are. And there's one, this is a slightly morbid example on this, but post 9/11, people became fearful of flying, with clearly understandable, and so they still had to get from point A to point B. So what do? The answer is you drive. Well, driving's great because you're now in control, right?
Right.
Well, it turns out researchers have studied this, and they found that the additional fatalities as a result of more people taking to the road was about 50% more people than died in the actual airplanes on that day in 9/11.
Let's talk a little bit more about this illusion of control. So people feel as if they're in control, oftentimes even when they're not, right? I mean, you have this great example in the book, the study that was done with cards about people
lottery.
feeling. Yeah, so
So this is work done by Ellen Langer, very famous, she's at Harvard, very famous experiment. So they went to Long Island, they went to a business, and they said, we're going to play a lottery. Again, we're going to have 50 tickets, we'll sell them each for $1. And we're going to put them in there, and we'll pull out one, and whoever wins the $50. Okay, so everybody understands the math behind this. But the difference was some people were in control. In other words, they laid the tickets on the table, and they could select whichever one they wanted.
It was just picking the ticket.
Just picking.
It wasn't even picking the numbers like
right,
in a lotto.
Exactly. It was picking a ticket. Now they're all different. It was a card in effect. And then the other people were simply handed their card, right? So these were they were in control, and they were not in control. And so so everybody's sitting around, they're waiting for the big moment to happen, and then one of the researchers says, well, wait a second, someone else wants to participate, but we only have 50 tickets. So we need to buy one from someone that has one. So they first went to people that were given their tickets. They had no control of the situation. They said, how much are you willing to sell your ticket for? And on average, they said about $2. It's a little premium for excitement, but above expected value, but still. And then they went to the people that had picked their tickets, right? These are the people in control, and they said something just shy of $9.
They paid $1.
They paid $1, and the expected value was off, so $9, right? So you say
they wanted 4.5 times as much money as the people who've been given the car.
So exactly. So then you start to think about, this shows up in all sorts of manifestations, right? So even things like endowment effects. You put a stock in your portfolio. You think you're in control of the situation, right? You think you're in a better position than you really are.
So we have these illusions, we have this sense of overconfidence. How do you puncture it? How do you deal
so
with it?
The core idea here is, and this is this idea carries a lot of freight, is something that Danny Kahneman calls the inside versus the outside view. And the inside view is when we face a problem, and this is what we all do. You gather lots of information about it, you combine it with your own inputs, and then you project into the future, right? And this could be stuff like trivial. Your professor say, when can you hand in your term paper? This could be, when will I launch my new product? The outside view, in contrast, says, I'm going to be able to ask the question, when other people have been in this position, what happened to them, right? You can now tap the database of humanity, right? So it's a very, very different way of thinking about the world, because you have to leave aside basically all this cherished information. You have to leave aside your inputs, and you have to sort of rely on this group. Now, a lot of decisions we make are unique to us.
Sure.
Right? You're an executive, or you're even making personal decisions, unique to you, but lots of other people have been through these things before. So this is a really, really big deal, because this, again, the reason it's called Think Twice is the natural way for you to think is the inside view.
Right.
And the outside view is very natural, so you almost have to extract yourself from all that you believe and think and the information. And by the way, it's interesting, the researchers study this about when people are trying to solve problems, about 3/4 of the time they gather information. That's their primary mode is just to gather information, rather than conceptualize the problem.
A lot of people will say, if I don't believe in myself in this way, that I can't. So is there a way to balance those two things?
I think, look, the thing is about this optimism, I said this optimism leads to the illusions, but in a sense this optimism is what gets us up in the morning every day to go out there and do it again. So, I'm not sure that I'd want to totally quash this for the whole world, because, and by the way,
if Steve Jobs didn't think he was special, he would never have created
and by the way, I have to believe this is something that's evolutionarily embedded in us. So in other words, our ancestors were people that were the optimists, they were the guys that are willing to run into the walls many times as necessary to get the job done. So there's got to be something inherently good about that. But by the same token, I think that, for example, an executive, you want to be mindful of this. I'll give you one example where this is great, is mergers and acquisitions, right?
Classic example.
You study this for decades. We know the statistics that about 60% of the time the acquiring company stock goes down. Yet,
so it destroys value for the company that does the
deal. Yet executives consistently believe the deal that they're doing is going to be a good one.
Well, it's interesting too, because if you actually look at CEOs, we know that and this is in a way kind of obvious, but CEO hubris, as measured by magazine covers or awards, tends to correlate with underperformance.
Exactly.
Because you would think the more praise you get, the less likely you would be to take the outside view, right? I mean,
totally, that's one facet. There's another thing that's really interesting about all the magazine stuff, and I mentioned some of these studies on this, is this study of superstars,
right.
which is there's a lot of evidence that so you say you're a sports team or you're a company, how do you improve your performance? One of the natural things you might say is just bring in the great superstar, bring in that great CEO or that great star player who's going to lift our performance.
Right.
And very frequently those performances are disappointing. And part of it is because simple reversion to the mean, that they may have been benefiting from other things. And other things are just the nature of the system. In other words, there may have been things that were happening in your prior team that made you a better player that are not exist in your current team.
Now that flows into another one of your lessons that I think is really fundamental, which is in a sense that context really matters. That sort of situational factors oftentimes have a really big effect. And one of the points of taking the outside view is it actually allows you to see that to a greater extent. But as you talk about, it's hard for us to recognize or admit that context really matters. So can you talk a little bit about that?
Well, I think this is the most, of all the things, this is most disquieting of all the points in the whole book, is that what goes on around you affects you much more profoundly than you're certainly aware of. A lot of this is below your consciousness. By the way, often I like to introduce this with an experiment I do with my students at Columbia Business School. So the very first day of class, we just did this in January, I asked them to write down the last 4 digits of their phone number, right? No problem.
Okay.
And then I asked them, how many doctors are there in the borough of Manhattan?
Okay.
Right.
2 things have nothing to do with each other.
And they know they have nothing to do with each other, right? There's no one has any doubt about this. But for those students who have low phone numbers, they guess there are 17,000 doctors. Those people who have high phone numbers guess there are 29,000 doctors. And the people with middle phone numbers guess there are 21,000 doctors. They know that it's random, but this effect is very pronounced. So, by the way, I was giving this talk, I was talking about this exact point. I was in London a few months ago, and it was a large group. And I said to the guy hosting the meeting, I said, can we try this right now? Like, we've just talked about the principle of anchoring. Can we try this? And he's like, go for it. So I had him write down the last 4 digits of their phone number. And then I asked him what year Attila the Hun died, right?
Okay.
Which I didn't know the answer, but it doesn't matter, right? Low phone numbers, he died a long time ago. High phone numbers, he died more recently. One guy wrote 1975, and even I knew that one, right? And then a middle number. So the point is, it's a very powerful influence and a very difficult one to manage away.
Right.
The other experiment I love in the book, which is also one of my favorites, is the one of wine. Right. So here, researchers went to a supermarket and they set up the wine section with French and German wines. They're roughly matched for price and quality. They put a little French flag and a German flag so people would have, and then over a 2-week period, they alternated playing French and German music.
Right.
And it turns out when they're playing French music, people buy French wine 77% of the time. And when they play German music, people buy German wine 73% of the time, right? So this incredible effect. So people are walking out, and the researcher goes and they tug them on their sleeve and they say, hey, can we ask you a couple questions? Sure. Did you hear music today? Yeah, I heard it. It was very nice. They say, did the music have any influence on your purchase decision? 9 out of 10 people say no, right? So again, like this incredible revealed significance, yet somehow it's not registering in our subconscious minds.
Right.
So then you say, this stuff is frightening, right? Then you just throw yourself into the real world and you see these things all over the place. So how do you deal with it? I think part of it is to raise your awareness to the degree you can. I mean, just be thinking about what's going on around you as you're deciding. And second thing I would say that's more important is, if you're someone that manages, you're a manager, you're an executive, you have to recognize that you're creating a decision-making environment for those that work with you. Right?
So you're shaping the context in which people...
You are shaping the context, right? So you like to think that they're going to be objective and fact-based and rational, but in a sense, they're going to behave in a way that reflects the context that you set up. So as an executive, try to think about that you want to create, there are going to be environments that are conducive to good decisions and environments that are obviously much less conducive to that.
A lot of times, executives are cueing their subordinates without necessarily being conscious of it, but that can have a huge impact on the decisions people make.
I agree. And it's really hard to sort of be mindful of all these things, but it is important. There's one particular aspect of this that I like a lot, and that's the work on stress. And the guy on this is Robert Sapolsky, who's a neurobiologist out of Stanford, and his stuff is just all great, right? But he makes a point when he talks about stress that I think is really important, is when you are stressed, and by the way, humans rarely have physical stressors anymore, sometimes, but almost all of our stressors are psychological, right? It's relationships or money worries or job deadlines or whatever. But the important thing is it creates the same physical responses, And one of the big things is whenever you're stressed, you discount the long term, right? In other words, if you're a zebra being chased by a lion, you don't have to worry about next week.
Right. You just want to get.
So So you turn off your digestive system, you turn off your reproductive system, you turn off your immune system, because those are all luxuries, and you just worry about the here and now.
Right.
Well, the same thing happens to us is when we get stressed, we basically stop worrying about the long term and we focus on the here and now.
Right.
This could be part of this short-term thing.
Yeah, if you go back to March '09, I mean, that's right.
Exactly. And so you're the portfolio manager, and I walk in and I say, Jim, I've got a great stock. I'm sure we can double our money over the next 3 years. And you're the portfolio. You're going 3 years. I don't know if I'm going to have a job.
Right.
I need something that's going to work three months and preferably 3 days,
right.
so I can feel better. So all of a sudden, again, you start to shut off alternatives that would be potentially very favorable because of the stress induced. So now you can imagine, as a manager with people, if you're creating that stress for them, you're going to pull those time horizons in, and again, reduce alternatives and possibly very lucrative alternatives. So we're probably all different, neurologically a little bit, and so some of us are probably better than others, and I think these studies would actually back that up. But that's an interesting thing that even though you're checking it off, I know I'm supposed to be independent, I'm supposed to have these diverse views, right? You have to overcome your very innate fear.
Right.
To get to that spot, and that's really, it's hard to do.
Now, one of the other things that you're really interested in is the question of how do we separate skill from luck? How do we look at companies? How do we look at individuals and say, some of this is a result of genuine, persistent skill that lasts over time, but some of this has to do with context and so on. It seems like it's hard for us to admit that luck has a big role in the way the world works.
Yeah. Totally. So, the way I like to think about this is a continuum, right? And there's one side of the continuum is pure skill, no luck.
Okay.
Right? So if you and I do a running race where we play chess, the better man's going to win.
Right.
And then pure luck, no skill. So if you go to play slots or roulette, right? Okay. And then everything else is somewhere in between, right? And by the way, there's a really simple, interesting, elegant test of whether there's skill in the system, which is, can you lose on purpose?
Right.
And if you can lose on purpose, then there has to be some skill.
I think that's a great idea.
It's great.
Because if you think about investing, how hard would it be it would actually be hard to build a portfolio you knew was going to lose money.
That's the point, and that's really essential. Now, I actually believe there is skill in investing, but if you put it on the continuum, and you're honest, it's going to be much more toward the luck side, right? So it's a big difference between there's no skill and there's little skill.
Right.
Okay, but so the point is there are these different activities that lie along this continuum. But one of the things we know, any activity that has skill and luck combined is going to lead to mean reversion. Reversion to me is an axiomatic thing.
Right.
And I think humans are really bad at understanding and thinking about mean reversion. Corporate performance is another one where I think we underestimate the role of luck, of happenstance, and certain things happen that are somewhat outside the control of the management, and they either get great accolades for that or they get put in the penalty box. But, should we really be should they be adorning magazine covers?
Right.
Or not? So all these things like the sophomore jinx, the Sports Illustrated jinx, these are all things that come out of that idea of mean reversion.
And you talk about that study where the guy looked at all the covers of business magazines and then compared the companies that actually did end up on the business magazines underperformed significantly.
Yeah, it's the same exact idea. So what they did is they went to magazine covers and they rated them based on how positive the story was. So it was really bullish, they give them 5, and it's really bearish, they give them a 1.
Right.
And then exactly. Then they looked at their stock price performance, and what you expect is the guys that run the covers were ones that had done really well, and the guys that were goats who had done really badly. And then, of course, in the subsequent periods, the guys that had done badly outperformed the guys that had done well by a factor of 3 to 1.
What lesson do you take away from that? I mean, you're not saying that skill... See, the reason it's challenging is because skill, well, we assume, at least in some circumstances, in sports we know skill exists. It's very clear, right? But we also know luck plays a big... Should we just say we have no hope of measuring skill and just assume it's all random?
No, we should try to measure skill, but the key to think about in life is that when you see great outcomes, really, really great outcomes, it's almost always the combination of good skill and really good luck.
Okay.
Skill may be more persistent. By the way, athletes, of course, just age and so forth, so their skill will diminish from that. But skill may be more persistent, but luck, we know, it's almost by definition, it's going to be transitory, right? So if you see great outcomes, and then if you see really atrocious outcomes, it's almost always not so much skill and really bad luck. Okay. And that luck will also go away as well. So the extremes will move in. So again, any extremely good thing, any extremely bad thing, it may not, but your next thought should be it's going to be closer to the average, and just thinking about that way, I think is again very, very useful way to think about a lot of things that it doesn't come natural.
Right.
It doesn't come naturally to us as we go through our lives.
Let me ask you a kind of a difficult question, only in the sense that I want you to reduce your book down, and if there's sort of, let's say 3, there are 3 things that you want people to take away in terms of how we can improve our decision making, how we can improve the way we sort of move through the world in terms of accessing information and the like. What would the three most important things be?
Well, the point of the book is when we're faced with certain types of situations, our minds naturally want to flow one direction when the better way to think about is a different direction.
Okay.
So the first point would be to prepare yourself about these situations, learn about them, right? And create that little database in your mind so that next time we can talk about the inside-outside view, and we can go right to the short end and say, hey, Jim, you're using the inside view. Maybe you should think about it differently, right?
Okay.
And then automatically we're on the same page and you know what that means. The second thing I would say is that it's really important to learn at recognizing these things in context, right? So in other words, these situations are going to show up in different guises in different parts of your life. You're going to see them in your professional life for sure. You're going to see them in your personal life.
Right.
You're going to see them while you're watching the ball game or reading the news. Be able to pick them out.
Okay.
You know, is there a correlation causality problem, right?
Right.
Learn to find them when you see them.
Right.
And then the third thing is there are tools and techniques to try to mitigate these things.
Okay.
So learn about those tools and techniques so that how do I avoid the inside view versus the outside view? How do I think about and these are things that we were sprinkled through our discussion today, but learn about those tools and techniques and then try to bring those in. Think twice. The point is most decisions we make in life are either, you know, pretty straightforward or they're not very consequential.
Right.
You know, so you don't have to worry about this. But when you find yourself in one of these decision-making danger zones and the stakes are sufficiently high, that's when you need to sort of slow yourself down, right? Bring in friends, colleagues, family members, whatever it is, and try to think it through more effectively.